Hello there, so I'm back with another versus video. This time it's going to be Main Street Capital versus OWL Rock Capital. That's two business development companies. We're going to be looking at them head to head, just like I do in my previous versus videos. So we'll be looking at all the key metrics, and at the end I'll be letting you know if I'd be buying either of these two shares and at what price. If you're new to this channel, welcome. My name's Andy, and on this channel I like to talk about money and success. If you're interested in making, saving or investing money, please be sure to hit that subscribe button down below, hit the notification bell, and then you'll get notified every time I release a new video. And if you find this useful, please remember to hit the thumbs up, because that helps YouTube algorithm, which in turn helps me, and of course I do appreciate it. So what is a business development company? Let's start with that. We always start with what the business actually is and what it does. So a business development company, the easiest way to describe that to you is if you've watched Dragon's Den or Shark Tank, where the investors invest in a new company. The business development company is like the shark or the dragon doing the investing. Essentially, they lend money to businesses, and sometimes they take an equity stake, and sometimes they just lend a loan. Now, it's for companies that are basically too big for banks to lend to, but too small to be raising capital via other means, basically. So it's kind of the medium-sized companies that they are looking after, and they'll sometimes help with the management roles. If you watched my video about NEWT, ticker symbol NEWT, I'll put a link up there and in the description down below. That was also a business development company. If you've watched many of my previous videos, you probably know I already have a large holding of Main Street Capital, which is of course one of these companies which we're going to be comparing today. I've had a large holding of that for some time. I did announce that on my channel when I was buying those shares. So you'll see what price, if I was buying more, I'd be looking to get into again at the end of this video. I'll put a link to that previous video up there. And likewise, if you're interested in seeing my other versus videos where I've compared all kinds of things, I'll put a link up there and in the description down below to a playlist of those kind of videos so that you're welcome to check them out. What we want to do is decide which one is more risky. That's element number one. So they are both business development companies, and they both do the same kind of thing, but there are subtle differences. So I'm just going to quickly go through what a business development company is for you, in case you don't know that already. So we'll head over to my slides here. So Investopedia says, because business development companies are regulated investment companies, they must distribute over 90% of their profits to shareholders. The RIC status, though, means they don't pay corporate income tax on profits before they distribute them to shareholders. The result is above average dividend yields, according to BDCinvestor.com. As of May 2019, the 10 highest yielding BDCs were posting anywhere between 10.82% and 14.04% dividend yield, which I'm sure you know is a very high dividend yield. And if you've seen my retirement calculator, again, I'll put a link up there and in the description down below, you'll know a high dividend yield means you need a lower amount of capital in the first place in order to achieve your income goals. You can go and play around with the calculator to figure that out yourselves later. I'll put a link to that in the description down below, like I said. Investors receiving dividends will pay taxes on them at their tax rate for ordinary income. Also, BDC investments may diversify an investor's portfolio with securities that can display substantially different returns from stocks and bonds. Now, the pros and cons you can see listed there. So the pros: high dividend yields, profits not corporate tax, open to retail investors, and it's liquid, so you can buy and sell it easily. That's what liquid means. Cons: high risk, sensitive to interest rate spikes, and illiquid, untransparent holdings. Now, that sensitive interest rate spikes, we want to talk about that in a moment. I should also just add here, I am not a financial advisor. This is not financial advice, okay? Do not take anything I say in this channel as financial advice. These are just me giving you my opinions and thoughts on stocks and shares that I've researched. Hopefully you found it useful, but you need to do your own research, okay, folks? So that last little point there, sensitive to interest rate spikes. Now, Main Street Capital, one of the things it does is it takes a big equity stake, typically 40% equity stake, in the companies that it helps. So it will take equity as well as lending them finance and helping them with management. That's one of the key differences. I'm sure that OWL Rock does the same, but I've not been able to find out just how much OWL actually takes as an equity stake. That hasn't been clear to me. And the other thing I noticed about OWL Rock is they use something called CLOs. Let me just show you some bits from the slides now. This is from the OWL Rock Capital Corporation latest investor presentation that we could find. So you can see here, if you look in the middle, the average loan to value is 47% across the portfolio. So that's good. So far, so good. And there's a number of key points on there. But what I wanted to look at was this here, the evolution of financing landscape. Now, you'll notice we've got the revolving credit. That's fine. Special purpose vehicle assets facility. That's fine. Then you'll notice the next three rows there essentially turn into CLO. Do you know what CLO means? Let me show you. So a CLO is a collateralized loan obligation. So what does that mean? A collateralized loan obligation, or CLO, is a single security backed by a pool of debt. The process of pooling assets into a marketable security is called securitization. Collateralized loan obligations, or CLOs, are often backed by corporate loans with low credit ratings or loans taken out by private equity firms to conduct leveraged buyouts. A collateralized loan obligation is similar to a collateralized mortgage obligation, CMO, except that the underlying debt is of a different type and character, a company loan instead of a mortgage. You see, now I find that a little bit worrying. So that I'm putting as a bit of a weakness for OWL Rock. Basically, that for me is a concern. Mainly because I don't know what they've got in these CLOs. I do know, I can tell you I've looked into this a little bit further, and compared to some BDCs that use CLOs, they do it on a very low leverage scale. So compared to many other CLOs, they're relatively safe. But compared to Main Street Capital that doesn't use CLOs, I think it's a little bit more risky, which is why I'm giving this round to Main Street Capital. But you need to take your own view on that, and you might well decide, actually, there's reasons why you might think that they're equally viable. I mean, for example, Main Street Capital doesn't have anywhere near the amount of assets that OWL Rock Capital Corporation does, which you'll see in a moment. In fact, OWL Rock is actually the second largest BDC available on the stock market, so it has got a lot of assets under its control. It's not like we're talking about a small company here, and it's seen some good growth, but you'll see all that later when we get to talk about that. What I'm looking at here is the business model, and from my personal point of view, I think Main Street's is a little bit safer. And if we just look at Main Street's slide here, because as you remember, I pointed out that interest rates are a big issue for business development companies. And this is because they basically borrow at one rate and lend at another rate. And the difference is, of course, profit. But let's have a look at how Main Street Capital organises theirs. You'll notice there 79% of Main's outstanding debt obligations have fixed interest rates. So that's the money they owe is fixed, which limits the increase in interest expense, and 72% of Main's debt investments bear interest at floating rates, the majority of which contain contractual minimum index rates or index rate floors. So that means there's a minimum amount they can make on the amount they lend to the companies, but they allow it to float up so they can make more, yet they've actually fixed most of their borrowing that they've borrowed themselves. So if interest rates go up, they've actually protected that downside, which is what you'll see it says at the bottom there. This provides Main the opportunity to achieve significant increases in net investment income if interest rates increase, with a limited remaining negative impact if interest rates decrease. And I think that's very important. And that, combined with the CLO issue and combined with the fact that I know that Main take a big equity stake, generally speaking, is why I'm giving business risk to Main. And there it is. So we start off 1-0 to Main, business risk. Let's see how it continues. So now we're looking at the 1-year chart. So you can see it's been pretty flat. I mean, you had the dip around March 2020 when the entire stock market collapsed basically. And you can see over the course of the year, it's actually down 21.47%. You can see they've got a P ratio of 17.4. So that would usually indicate fairly good value. They've got a dividend yield of 7.03%, which is of course fairly high. And I can tell you now, it's 12.3% down from its 52-week high. If we look at its 10-year chart, you can see the general trend has been up. And if you'd have owned it over the last 10 years, you would see that you would have basically doubled your money despite the current drop. So from 10 years ago to today, you would have basically doubled your money just in capital. That's not including the high dividends that you would have been getting. So if you'd have put $1,000 or £1,000 in 10 years ago, you'd now have 2,000 in capital and would have, of course, been benefiting from the high dividends, which in the case of Main Street Capital is monthly. Now let's look at OWL Rock Capital Corporation, ticker symbol ORCC. You can see if you're doing that over the last 12 months, it would actually be down 12.31%. Now then, they've got an even lower PE ratio of 10.5%, the even higher dividend yield of 8.93%, and notice the market cap 5.42 billion, which is bigger than the market cap we saw there for Main. If I just flick back to Main a second, you can see Main has a 2.32 billion market cap. So ORC is definitely bigger in terms of market capitalization. Now I can tell you from the 52-week high, OWL Rock Capital Corporation, or ORC, is down 6%. Now I can't give you a 10-year chart because this company has not been around for 10 years. But you can see if you'd have bought it at inception and held it until today, you would have actually lost money. It would have gone down. So it started off a lot more valuable than it is at its current price today. Now, I don't want you to make this put you off the video and make you think actually OWL Rock Corporation, forget them. Bear with me, let's see how the rest of this video goes. I think you'll see there's some interesting twists coming, particularly at the end. I've got an interesting surprise, something that I don't normally include in my versus videos, so you'll have to watch out for that. So the end of that round there, business risk, obviously you already know. PE ratio, we have to give that one to OWL Rock Capital Corporation because at 10.57 its PE ratio is a lot lower than that of MAIN. Dividend yield, again, OWL Rock Capital Corporation wins because it's much higher. Share price value, actually the share price value, I'm giving that one to MAIN simply because from its 52-week high, it has fallen further than OWL Rock has, and therefore it's got more room to recover. That said, you should bear in mind that OWL Rock Capital Corporation is down from its previous highs, and so if it did go back to those kind of levels, then actually OWL Rock Corporation, it's a tongue twister, isn't it? OWL Rock Corporation would be the winner. So you have to, use your own judgment on that. You might want to give that one all, because I've gone over just a 12-month period, I've given it to MAIN. But it could have gone either way. If I'd have looked over a longer period of time, that would have gone to OWL Rock. But as I always use a 12-month period, that's what I've used for this versus video as well. So that's what I've gone for. But I do want to make you aware that's kind of a close call, that one. The price to book value. Now, this is a new little metric. I don't normally include this for you, but I included this one simply because OWL Rock Capital is currently trading at below its price to book value, which is a very rare thing to see happen. That means its assets, if you were to sell all of its assets are actually worth more than the share price. So if you buy it at today's price, you are actually buying it at a discount. MAIN's book value is $21.52 per share, and it's currently trading at about $35 per share, whereas OWL Rock Capital Corporation's book value is $15.24 per share, and it's currently trading in the $13 range, so at a substantial discount. Okay, so now let's check out the income statement. So if you take a look at the gross profit line there, you can see that since 2015, Main Street Capital has been increasing its gross profit year on year and has had a slight drop in the trailing 12 months. If you then look at the operating income, you can see a very similar story. It's been increasing it year on year. Then in the trailing 12 months, we've had a drop. And if you look at the net income, that's at the bottom of your screen now. Again, you can see it was increasing. In 2019, it dipped. And if you look in the trailing 12 months, it actually went negative. That, my friends, is not a good thing. That means there's a loss going on there because that is essentially your profit line, okay? So when your net income's negative, that's bad. So now let's look at them same metrics for OWL Rock Capital Corporation. So you can see the gross profit has been growing and even grew in the current period. The operating profit sells the exact same story. There's the net income now. Now you'll notice the net income has dipped in the trailing 12 months, but it has not gone negative. So I would say that is a win to OWL Rock Corporation, and look at the growth there. That is phenomenal growth. And what I want to do is actually show you a graph just so you can see the growth comparison. The orange line there is OWL Rock Capital and the blue line is Main Street Capital. If you look, back in 2017, OWL Rock was actually making less gross profit than Main Street Capital. It overtook it about there in Q1 of 2018. And since then, it's just been up and away, while Main Street has essentially stayed fairly flat. And if you look, since Q1 of 2020, Main Street actually started to go down. And if you look at the top there, you can see that OWL Rock also went down, but only in the last quarter of 2020. But it's moved up so much, it's basically stayed flat. So I think given you've seen that, you can really understand why on the income statement front, I have to give that win to OWL Rock Capital Corporation, because quite clearly it's seen better growth, and in the recent 2020 pandemic, it has handled it better, quite frankly. It hasn't had such a big dip that Main Street Capital has, which, it's reported a loss, so which is never good, whichever way you dice it, I'm afraid, folks. So now let's look at the key dividend data. So this is Main Street Capital. You can see you've got a 7.03% dividend yield. It's paying out $2.46 per share per year. Its current payout ratio is 122.24%. Now, if you remember earlier, they have to pay out a minimum of 90%. So this is quite common to see high payout ratios, but over 100% is pushing it really. But bear in mind, they made a loss last year. So it's obvious. Any payout will be over 100%. It's as simple as that, quite honestly. They have a 5-year growth rate in their dividend of 1.66%, and they've been growing the dividend according to Seeking Alpha for 2 years. If we quickly look at the dividend chart, you can see that Main Street typically pay a special dividend every now and then, but other than that, they pay their dividends monthly. And they suspended their special dividends in 2014 and just continued their regular dividends. OWL Rock Capital Corporation, their key metrics here, 8.93% dividend yield, so almost a 9% dividend yield, which is pretty good. Whichever way you look at it, I'm afraid. Annual payout is $1.24 per share. The payout ratio is 94.37%, which I appreciate sounds high, but bearing in mind it's a BDC, that's actually okay. 5-year growth rate, there is none according to this, and a dividend growth of 1 year. So if we take a look at the dividend history, you can see they're paying it quarterly, and they have a quarterly dividend and then a special dividend. And I noticed they keep the quarterly dividend the same, and then they've been increasing the special dividend. So they have been increasing that special dividend even in 2020. You'll notice there 2020-08, 2020-08, 2020-04 at the beginning. So it actually went up, and in 2019 it was 02. So it has been increasing, and in January 21, 08. So they have been increasing the amount of the special dividend, but we haven't got very long dividend history with them at all. So for dividend safety, we have to give that one to OWL Rock Capital Corporation. 94.37% payout ratio is clearly a lot safer than 122.24% payout ratio. And also bear in mind, OWL Rock Capital Corporation made a profit, Main Street Capital made a loss. You can't continue paying dividends if you're not making a profit. Clearly that's a safety issue. So you have to give dividend safety on that metric to OWL Rock Capital Corporation. Dividend growth rate, Main has an increase, OWL Rock doesn't. Now, this is another one where we could have given it 1-all, because remember the special dividends, OWL Rock has been increasing its special dividends, whereas Main Street Capital kept it the same. So do you know what? I'm going to give it 1-all. We're going to just change it right now. The beauty of live TV. It's not live, is it, folks? But you know what I mean. We're giving that 1-all. Dividend growth rate, 1-all. I'll have to change that on all future slides now. Anyway, dividend growth rate for years. We're going to give that to Main because it's done it for 2 years. OWL Rock, we don't have a very long track record, so we can't give it OWL Rock that one. Okay, now let's look at the assets versus liabilities. If you've watched any of my previous videos, you know I put a lot of weighting onto this. So the total assets versus total liabilities ratio for Main is 2.15, whereas for OWL Rock Capital it's 2.25. Anything over 1 is good, so over 2, phenomenal. So both of these really good in that metric. Current assets versus current liabilities. Current assets versus current liabilities for Main is 0.81. I would like to see that above 1, so I'm not overly unhammered with that. With OWL Rock Capital it's 1.37, so that's a big thumbs up. So on both of those metrics, that would be a win to OWL Rock Capital, although both of them have a very good ratio for assets to liabilities. So I've also given a point to Main as well, and if you remember, I need to update that there to make it fair. There we go. So now let's take a look at the balance sheets. So here we're looking to see assets increasing, debts decreasing, and equity increasing. That's what we're hoping for anyway. So let's see what actually happens. So you can see here, this is Main Street Capital. So if we look at the total current assets in 2015, it was 58 million. And if we look in the last report, it's 65.5 million. But you'll see it was climbing every year up until 2019. Then there was a dip in the last report. So we need to make a little note of that. If we look at the total assets, you can see the same kind of picture. So 2015 through to 2019, continual lovely positive growth. And then the latest report, we've seen a little dip. If we look at the total liabilities there, you can see they've continued to increase year on year. So if we find the total equity, you can see it was increasing beautifully right up until 2019. And again, that dipped in the latest trailing 12 months. Now we're going to look at the same, but for OWL Rock Capital. So OWL Rock Capital, we've got cash actually dipped in 2017 and then has been on a climb up, but again, dipped in the latest period. But let's look at total assets. Let me find asset. There we go, total assets there. So the total assets in 2016, 1.1 billion that would be. By the time we get to the latest report, it's up to 10 billion. And notice as well, it's increased even in the latest report. So 2019 to 2020 was an increase, not a decrease, which is obviously a good sign. The total liabilities, you can see there at the bottom, they have again also increased. So let's see what's happened to the equity, which is very important. So total common equity there, you can see that's been increasing. Again, that dipped in the last report. So it was increasing up to 2019, but dipped in the last report. So on the strength of that, again, we have to give that one to OWL Rock Capital Corporation. It basically wins on having a greater growth and a smallest percentage equity dip in the trailing 12 months. I know they both dipped, but if you look at it in percentage terms, the percentage dip for OWL Rock Capital was much smaller than the percentage dip for Main Street Capital Corporation, which is why I'm giving that one to OWL Rock Capital Corporation. Now let's look at the forecasts. So this is the Analysts 12-month forecast for Main Street Capital Corporation. There's only two analysts reporting on it. One gives it a buy, one gives it a hold. So none of them are selling, which is nice, especially when you consider one of them says that in 12 months time it'll be worth $34 per share. That's the upside. One of them says it'll be worth $34 per share. That's the downside. So the high and the low are exactly the same. Either way, they're both down because the current share price is $35.63 per share. So there's a downside of 4.57%. Hardly makes for an enticing investment, that does it? So now we'll look at exactly the same for OWL Rock Capital Corporation, ticker symbol ORCC. Now this time there's 4 analysts reporting on it, 2 for a buy and 2 for a hold. So again, there's no one offering to sell, but again, they're showing a downside of 1.44%. We've got a high of $14.50, which is obviously higher than it's currently trading at, because it's currently trading at $13.67, and a low of $13. So quite clearly on that metric, we have to give that one to OWL Rock Capital Corporation. And that brings the final scores to 11 to OWL Rock Capital Corporation and 4 to Main Street Capital Corporation, which is one of my bigger holdings, I hate to admit. So yeah, it's been slaughtered in this head-to-head comparison, hasn't it? But don't leave me just there. I'm now going to show you what target buy price I would have on either of these two shares. I'll show you how much you'd have to pay in order to get certain dividend yields on these two stocks. And I'm also going to show you that little surprise that I promised you earlier as well. So keep watching. This chart here, this simply shows you the current price. So I've put purchase price. If you was to just buy them at the current purchase price, these are my best guessed forecasts. Now bear in mind, my best guesses. These are not, I don't have a crystal ball. These are just how much I think it would be worth, either of these two shares, over 1, 2, 3, 4 or 5 years. It's just a bit of fun. We'll be able to look back in a few years' time and we'll go, Andy, you were the man, you were right, or got it well wrong. But these are my best guess forecasts based on what I've researched here. So this is if you were to buy them at current purchase price. And I'm going to show you if you to buy them at my target purchase price and how that makes a difference. And then I've got that little surprise as well. So you can see if you to buy them at the current purchase price in a year's time, I'm actually expecting Main Street Capital to go down. I'm expecting OWL Rock to stay about the same. In 2 years' time, I think actually Main will be up a bit. And if you look, if you hold them for 5 years, you're probably up about 20%. Now bear in mind that's your capital. That doesn't account for your dividend gain as you've been doing it. Now that table at the top right there, that shows you how much you would pay for the shares to get a certain dividend yield. So for example, if you wanted to get a 9% dividend yield with Main Street Capital, you'd have to buy it for $27.33 per share or less. You'd be very lucky to do that, but that's what you'd have to buy it for. If you wanted an 8%, you'd have to wait for it to drop to $30.75. It's actually close to a 7% dividend yield right now already at its current price. So you probably could get the 7% yield by buying it at $35.15 per share. Now, OWL Rock Capital, to get a 7% dividend yield, you could pay up to $17.07 per share. Bear in mind it's currently trading at $13.87 per share, so there's no need to do that. If you were waiting to get above the yield that it's on now, which is almost 9%, it's 8 point something percent if you remember correctly, then a 9% yield, you just got to buy it for $13.78 per share and you're getting a 9% yield. Now if it happens to drop to $12.40 per share, then you can pick yourself up a 10% dividend yield, and this is where my little surprise for you comes in. If you look on here, what this shows you is the actual insider buying for OWL Rock Capital Corporation. And you can see the vice president picked up $200,000 worth of shares at $13.33 per share. If you look further down, you can see Chris Temple, one of the directors, purchased $20,000 worth of shares at $13.35 per share. And if you look at the very bottom there, you can see that the CEO, Craig Packer, purchased nearly $1 million worth of shares in this company at $13.85 and 17 cents per share. And notice that all of the sales are all from the University of California. Quite clearly, the university had a big stake in this company and needed to raise some cash. And you can see they've literally sold millions out of it. So that won't have helped the share price of OWL Rock Capital, but you can see that the insiders, the directors and the CEO, have been making substantial stakes, and you can see the price which they have been making them substantial stakes at. Which brings me to my purchase price, my target price. So my target price, basically for Main Street Capital, anytime Main Street dips under 30, I buy. Now, I want to caveat that at the moment, because it's making a loss, I'm probably holding off. I would like to see the next set of results. And also, at the moment, its current price is way above the 30. I bought it for way below the 30, so I'm actually quids in. I'm many thousands up on my Main Street Capital investment. Thank you very much, Mr. Stock Market. But I wouldn't buy them above $30 per share. Whether you do, your call. But me personally, I wouldn't, and at the moment, I'm not buying any more Main Street Capital, even though I remain a fan of the company. I'm not selling. I know they've made a loss, but last year was a naff year. Let's be totally honest. It was a pandemic. Things were locked down. I don't expect a company like this to necessarily make profits, which makes it even more impressive that OWL Rock Capital did make a profit. So good on OWL Rock Capital. So that is a company I would be looking to invest in. Despite the CLOs, it's got a very high dividend yield. They've demonstrated that they can do well even in a pandemic. Not many companies can do that. They have, so fair play to them. I'm impressed with that. And the price I would be looking to buy them for would be $13.30 per share or lower. In an ideal world, I'd like to get them under $13 per share. But if you remember, the CEO, the directors, they were buying at that kind of price level if it's good enough for them and they understand the company, and bear in mind it is below book value. So with that said, even the current price is probably a good buy. It's certainly a high dividend yield, so it's one to consider. Anyway, I really hope you found that helpful. Leave me any comments down below. If you would like me to make a versus video about any other companies, pick 2 high dividend yield companies. I'm particularly interested in dividend companies. 2 from the same sector. Let me know in the comments down below. If you've already requested one, please bear with me because I do have a big list and I do just pick from the list whichever ones I fancy, to be quite honest with you, but I will work through it all one day. And yeah, thanks for watching and goodbye.